Welcome to 14th session of Management Accounting, 5th semester BBA, Bengaluru North University. In this session, we are going to discuss turnover ratios, meaning, types and their significance. In the previous class, we have solved some simple problems on capital structure ratios. The main objective of this chapter is to familiarize the students with the ratio analysis as a tool for financial analysis. The main session outcome is that the students will be able to understand the various turnover ratios and their significance. Now, turnover ratio. It is also called as performance ratio or it is also called as activity ratio. This ratio is used to indicate the efficiency in which the assets of the firm are utilized. These ratios are also known as turnover ratios because they indicate the speed with which assets are being converted into sales. These ratios expresses the relationship between sales and various assets. A higher turnover ratio is generally better use of capital resources, which in turn has a favorable effect on the profitability of the firm. Then, what are the types of turnover ratio? The first type is inventory turnover ratio. Inventory turnover ratio is also called as stock turnover ratio. This stock turnover ratio is calculated by dividing the cost of goods sold by average inventory. The formula for this is inventory turnover ratio is equal to cost of goods sold divided by average inventory. The important things you should remember while calculating inventory turnover ratio is how to calculate cost of goods sold. The formula for cost of goods sold is sales minus gross profit. One more formula is there for calculating cost of goods sold, that is opening stock plus purchases plus carriage inward plus other direct expenses minus closing stock. Then formula for average stock is opening stock plus closing stock divided by 2. Then, if the cost of goods sold is not given in the problem, then we can take sales instead of cost of goods sold. Next, significance of inventory turnover ratio or stock turnover ratio. This inventory turnover ratio indicates the efficiency of a firm's inventory management. Then this ratio gives the rate at which stocks are converted into sales and then into cash. A low inventory turnover ratio is an indicator of dull business. A high stock turnover ratio is considered better as it indicates that more sales are being produced by each rupee of investment in stock. A very low level of stock results in frequent out of stock position. Thus, too high or too low inventory turnover ratio may not be good and should be investigated further. And the last is a company should have a proper inventory turnover ratio so that it is able to earn a reasonable margin of profit. Next, second one is debtors turnover ratio or receivables turnover ratio. This debtors turnover ratio indicates the relationship between the net credit sales and trade debtors. It shows the rate at which cash is generated by the turnover of debtors. The formula for this is debtors turnover ratio is equal to credit sales divided by average debtors. The next one is debtors collection period. It is also called as debt collection period. The meaning for this is it indicates the period during which the amount is uncollected from the debtors, or it indicates the average time taken to collect or recover cash from debtors. The formula for this is debt collection period is equal to 365 days divided by debtor turnover ratio, or we can write debt collection period is equal to average debtors divided by credit sales into 365 days. Note, here debtors means we should not only take only debtors, we have to take debtors and also bills receivable. Then debtors means we should not deduct reserve for bad debts from the debtors. That is called as, see here in the second note, reserve for bad debts should not be deducted from the debtors. Then how to calculate the average debtors? That is opening debtors plus closing debtors plus opening bills receivable plus closing bills receivable divided by 2. Then, if opening debtors and opening bills receivable is not given in the problem, then we have to take closing debtors and closing bills receivable. What is the significance of debtors turnover ratio or receivables turnover ratio? First one is, if current asset debtor is in the current assets, debtor is the very important item, and this ratio indicates as to how many days average sales are tied up in the amount of debtors. Next, by this debtors turnover ratio, efficiency of debt collection is also indicates. Then a higher debtor turnover ratio indicates that debts are being collected more and more quickly. Then changes in the debtors turnover ratio show the changes in the company's credit policy also, or changes in its ability to collect from its debtors. Then this debtors turnover ratio is also an excellent supplement to the information provided by current ratio. Next one, creditor turnover ratio. Creditor turnover ratio measures the relationship between net credit purchases and average creditor. It is also known as account payable ratio. Formula for creditor turnover ratio is credit purchases divided by average creditors. Next, debt payment period. Debt payment period indicates the period during which the amount is unpaid to creditors, or this debt payment period indicates time taken to make payment to creditors. Formula for this is debt payment period is equal to 365 days divided by creditors turnover ratio. Or one more formula is there, debt payment period is equal to average creditors divided by credit purchases into 365 days. Next, note, creditors. Here creditors includes creditors plus bills payable. Average creditors, the formula is opening creditor plus closing creditor plus opening bills payable plus closing bills payable divided by 2. And in the problem, opening creditor and opening bills payable, if it is not given, we can take only closing creditors and closing bills payable for the average creditor. Next, significance of creditor turnover ratio. Creditor turnover ratio indicates number of times the payment made to creditors in a year. Next, a higher creditor turnover ratio indicates that more operational efficiency of an organization. Fixed asset turnover ratio. This fixed asset turnover ratio indicates the efficiency with which the fixed assets are utilized. How efficiently fixed assets are utilized, we can come to know with the help of fixed assets turnover ratio. The formula for this is cost of goods sold. If cost of goods sold is not given in the problem, we can take sales divided by net fixed asset. Then note, as we have discussed, cost of goods sold is equal to sales minus gross profit. One more formula is there, that is cost of goods sold is equal to opening stock plus purchases plus carriage inward plus other direct expenses minus closing stock. Then net fixed assets means fixed assets minus depreciation. Significance of fixed assets turnover ratio. A high fixed asset turnover ratio indicates efficient utilization of fixed assets in generating sales, and a low fixed asset turnover ratio signifies that firm has an excessive investment on fixed assets. Next, current asset turnover ratio. This current asset turnover ratio indicates the efficiency with which the current assets are used, how efficiently current assets are utilized in the organization. We can come to know with the help of current asset turnover ratio. The formula for this is current asset turnover ratio is equal to cost of goods sold. If it is not given, we can take sales divided by current assets. So already we have discussed how to calculate the cost of goods sold. Next, significance of current asset turnover ratio. A high current asset turnover ratio indicates good operational efficiency. If it is low current asset turnover ratio means it is a poor operational efficiency. Next, capital turnover ratio. This capital turnover ratio shows the relationship between cost of sales or sales and total capital employed. The formula for this is capital turnover ratio is equal to cost of goods sold or sales divided by total capital employed. Then note. So already we have discussed how to calculate the cost of goods sold. Directly we are going to discuss about the capital employed. What is the formula for capital employed? Equity share capital plus preference share capital plus reserves plus debentures plus long-term loan minus fictitious assets minus non-operating expenses. Next, significance of capital turnover ratio. Capital turnover ratio shows the efficiency with which capital employed in a business is used. If high capital turnover ratio is there, which indicates the possibility of greater profit. A low capital turnover ratio indicates insufficient sales and possibility of lower profits. Then multiple choice question. The first question is turnover ratio is also called as. Options are activity ratio, inventory turnover ratio, debtor turnover ratio and creditor turnover ratio. The correct answer is activity ratio. Second one is cost of goods sold is equal to sales minus dash. Options available are purchases, gross profit, net profit, sales return. The correct answer is gross profit. Next, third one. Debt collection period is equal to 365 days divided by debtor turnover ratio. Options available are 230 days, 320 days, 365 days. None of the above. The correct answer is 365 days. Next, fourth one. Dash is equal to credit purchases divided by average creditors. Options available are debtors turnover ratio, creditor turnover ratio, capital turnover ratio, fixed asset turnover ratio. The correct answer is creditor turnover ratio. And the last multiple choice question is dash is equal to cost of goods sold or sales divided by capital employed. The options available are debtor turnover ratio, creditor turnover ratio, capital turnover ratio, capital turnover ratio. The correct answer is capital turnover ratio. These are the books you can refer. Thank you.